Welcome to Breaking News to Trading Moves. Today we're looking at a single corporate finance move. And when you look at it closely, it reveals quite a lot about where capital is flowing in the market right now, and maybe more importantly, where it isn't.
That's right. We're talking about OSI Systems. The ticker is OSIS. They just closed a major funding round. Specifically, they priced an upsized $500 million offering of convertible senior notes.
Okay, so $500 million is a big number on its own, but you said the terms are where the real story is.
Exactly. That's where it gets compelling.
So this is $500 million they've secured until 2031. That's a 7-year maturity. And the coupon, the interest rate they're paying is just 0.5%.
0.50%.
That's it. It's an astonishingly low rate for debt that goes out that far.
It's just remarkably cheap funding.
It is. And you have to note, they upsized the deal. That means the initial demand from investors was so strong that OSIS, the company, ended up taking more cash than they even planned.
And that alone tells you something. It tells you the market is hungry for this specific type of security.
Which brings up the question, why would any investor accept what is, effectively a 0% interest rate in today's environment, especially for a note that doesn't mature until 2031? It sounds like magic money for OSIS.
It's definitely not magic, but it does point to a very specific dynamic.
Yeah.
It's all about investor confidence in the company's future equity value.
Because these are convertible notes.
Exactly. For you, the investor, the trade-off is this. You accept that tiny 0.50% interest payment, but in return, you get the option to convert your notes into OSIS common stock later on.
But only if the stock price goes up.
Only if it rises above a preset conversion level, yes.
So the person buying these notes is basically saying, look, I'll forget about any real interest income now because I believe the OSIS stock will go up so much over the next 7 years that I can just turn this debt into stock and make a huge profit.
That's precisely the bet. So the successful upsized deal, it's a massive vote of confidence. It shows just how favorable conditions are for companies that can access this corner of the structured finance market.
And OSIS has plans for the money, right? They're not just sitting on it.
No, they're using it strategically, paying down some higher cost debt on their credit facility, doing some share buybacks, and just generally keeping that strategic financial flexibility.
Okay, so let's start with the immediate winners from this.
Yeah.
If the deal went this smoothly, who benefits right away? Let's start with the sector itself, security and specialized electronics.
Well, the first and most obvious beneficiary is, of course, OSIS itself.
Right.
They've swapped out more expensive, shorter-term debt for this ultra-low-cost, long-term financing, and the buyback part is also very tactical.
How so?
Well, using some of that cash to repurchase their own shares helps to offset the potential future dilution that the convertible notes represent. So that action provides immediate support for the stock price.
And when a company in a field like this, specialized technical field, pulls off a financing this successful, does that help its peers? Does it lift other boats?
Absolutely. The positive sentiment,
Right.
It extends beyond just OSIS. Other specialized electronics and industrial names, companies like Teledyne Technologies, ticker TDY, they see a secondary benefit.
Okay.
Their investors and analysts see this deal and they note that if OSIS can get capital this cheaply, maybe the cost of capital assumptions for the entire peer group should come down a bit.
It suggests a level of comfort with the whole sector's growth story.
Yes, a general institutional comfort.
Now, beyond that immediate sector, what does the success of this deal say about the overall market for convertibles?
It says a lot. It's a very clear signal that the U.S. convertible market is, it's wide open. And it's highly accommodating, particularly for these mid-cap names. It proves there's a huge pool of capital just ready to participate on what are, frankly, exceptionally friendly terms for the issuer.
So paying almost nothing for money.
Pretty much, which is good news for other companies that rely on this type of capital structure to fuel their growth.
Right. I'm thinking of companies in, say, high growth or high capex environments.
Exactly. Names like Sunrun, ticker RUN, and Plug Power, ticker PLUG, they come to mind immediately.
We've used convertibles a lot in the past.
Frequently. And the OSIS deal confirms that if they need to refinance existing notes or if they need to go out and seek more growth capital, the market is primed and ready to support them. That investor appetite is clearly robust.
So it's sort of a validation of the growth model that these industrial and green energy names are using.
It is.
Now let's turn to the facilitators. Someone had to put this deal together. Who made money on the transaction itself?
And that brings us straight to Wall Street. You know, pricing and placing a large upsized convertible note offering like this, it takes some very specialized expertise.
Of course.
So the firms with those dedicated, high-performing convertible desks are the direct beneficiaries.
So we're talking about the big bulge bracket banks that really specialize in this.
Correct. Banks like Goldman Sachs, GS, and Morgan Stanley MS, they generate substantial revenue from this. The deal flow, the fees from underwriting, the trading volume that comes after.
Right, once the notes start trading on the secondary market.
Exactly. And a clean, successful execution like this one, it doesn't just mean fees today. It boosts their reputation and it encourages other potential issuers to, give them the next mandate. When that convertible pipeline is active, these firms do very well.
Okay. So to recap the winners.
Yeah.
We have strong support for OSIS itself, good signs for its peers, a tailwind for other growth names that use this structure, and of course fee generation for the biggest banks. But any capital market event, especially one tied to future equity, it also creates pressure points elsewhere.
It absolutely does. And this financing decision by OSIS, it really shines a spotlight on the challenges faced by three very different groups. I think we should start with the people whose positions are complicated right away. The existing pure equity holders of OSIS.
Right, because even though the company used some of the cash for a buyback to support the stock, those notes still carry that risk of future dilution.
That is the key tension. If OSIS performs well, which, ironically is what everyone wants, and the stock trades well above the conversion price,
Then the bondholders will convert.
they'll exercise their right to become shareholders. And this influx of new shares, it dilutes the ownership stake and the potential earnings per share for everyone who already held the stock. This dilution risk, it kind of acts like a speed limit on the stock's appreciation over the long term.
And this concern isn't just for individual shareholders, but for, say, broader funds that track the whole sector.
That's right. If you own a specialized semiconductor or electronic component fund, something like a U.S.-listed ETF like XSD, and that fund holds OSIS, well, this future dilution risk is now part of your performance calculation. It's a constant consideration.
Now let's take that incredibly low 0.50% coupon rate and use it as a measuring stick against other parts of the market. The contrast is, well, it's pretty stark.
This is where you really see the capital market kind of dividing into a two-tiered economy. OSI Systems is getting capital almost for free, and they've locked it in until 2031.
Okay.
This really emphasizes how difficult and how costly it is to service debt for other sectors that simply cannot access the convertible market, especially the ones that are highly leveraged.
And I'm guessing you're referring to some of the legacy travel and leisure industries, maybe the cruise operators who took on so much debt when their ships were docked?
That's a perfect example. Companies like Carnival, ticker CCL, and Norwegian Cruise Line Holdings, NCLH, they are still servicing massive debt loads at much, much higher coupons, often paying many percentage points more than that 0.5% OSIS just locked in.
And that difference, that's not just a number on a page. That's real cash going out the door every single quarter.
It's highly restrictive. That high cost of capital is a massive drag on their operating earnings. Every dollar they spend on high coupon interest is a dollar that can't be used for, new ships or marketing or returning capital to shareholders. It limits their flexibility severely.
So OSIS gets cheap money and can do buybacks, which gives them a huge competitive advantage by comparison.
It creates a very different operating reality based purely on their access to financing.
Okay, that distinction is very clear. Let's revisit the growth names we mentioned earlier as winners: Sunrun, RUN, Plug Power, PLUG. We said the open convertible market is a good thing for them, but now you're saying they also appear on the pressure list. How does that work?
That's the complex dynamic that these types of companies always face. While the OSIS deal is great validation for the future financing needs of RUN and PLUG,
Right.
it also serves as a reminder to the pure equity investors in those names that this conversion structure is just the industry standard for them.
Meaning what exactly?
It just reinforces the concern that these convert-funded growth names, they often trade with this sort of built-in dilution overhang. The capital structures are complex.
So shareholders who prefer a simpler story.
Yes, exactly. Shareholders who prefer a cleaner equity story, where they don't have to constantly worry about millions of new shares potentially hitting the market if the stock does well.
Yeah.
They're reminded by the OSIS deal that more convertible issuance, or a big refinancing, is always a possibility for the companies they own.
So even though it wasn't their company issuing the notes, the fact that a peer did such a big, low-coupon deal reminds the market that future dilution is just the cost of doing business for this entire growth sector.
It weighs on the general sentiment. It confirms that the path forward for these companies requires this continuous reliance on a financial instrument that, pretty much guarantees some level of future equity leakage. And that can limit the stock's eventual valuation multiple.
We've certainly covered a lot of ground today, showing how one financing decision by OSI Systems quickly highlights several key market themes. You have the exceptionally low cost of capital for certain segments.
Right. The high growth, technically focused ones.
The robust investor appetite for complex debt structures like convertibles, and this profound divergence in financial flexibility between companies that can raise money at 0.5% and those that have to pay much, much higher rates.
It really boils down to one essential thought for you to carry forward. When you're evaluating companies, consider how the market's perceived value of future equity
Which is what allows for these cheap convertibles.
versus the current need for cash flow, which forces companies into that high coupon debt. Just think about how that defines their entire growth trajectory.
That access to capital and the terms of that capital really divides the market's opportunity.
It's the single most important factor determining which companies can accelerate and which ones have to just conserve.
Remember, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for tuning in. We'll talk to you next time.